Gold rose sharply today on bullish news from both inflation and the Federal Reserve. We're here to discuss this with Bart Melek. He is the head of commodity strategy at TD Securities. Bart, welcome back to Kitco. It's a pleasure to have you here again.
Great to be here again. Thank you for inviting me.
Bart, let's start with inflation first. The print on CPI was positive, 5.4%, so back up to 13-year highs. We've had a slight decline the previous month, but it's back. We've seen 5.4% again. So the gold market is not new to this level of inflation. Why the bullish action?
Well, I think fundamentally what we're seeing here is break even moving somewhat higher, pricing in higher inflation levels. And I think ultimately, given the fact that the Federal Reserve continues to signal that it is quite prepared to stimulate the economy and try to achieve full employment, it seems that full inflation control may be somewhat less important to them than we would think. And certainly market is looking through that, and real rates, I think, propelled this move to the upside. And we should remember that over the last few weeks, we've had quite a few short positions being built in gold. We also saw liquidations of long positions,
Sure.
And I suspect we might seeing some squaring of those bets, in essence, covering. And I think that, for the most part, was responsible for today.
Well, let's talk about inflation control. Gold did rise in the morning, but it didn't taper off in the afternoon after the Fed released its statements. And I'm just going to read an article from my colleague here at Kitco News, Anna Golubova. And I'm just going to read the first two paragraphs of her article. Federal Reserve minutes from the September meeting showed central bank officials looking to start reducing their bond buying stimulus program as soon as mid-November or mid-December, with plans to wrap up in the middle of next year. And this is a quote from the Federal Reserve Open Market Committee. Participants generally assessed that, provided that the economic recovery remained broadly on track, a gradual tapering process that concluded around the middle of next year will likely be appropriate. So it looks like they are going to start taking the tapering process a little more seriously, at least in planning. It's interesting how the gold market didn't react negatively to that after 2 p.m.
Sure. I think for the most part, this was well known and well telegraphed. The last FOMC, the Federal Reserve, I think pretty much let us know that November is when they are likely to start. Most likely $15 billion a month reduction in the QE asset purchase program, 5 MBS and 10 Treasury, and as the communique said, unwinding it by mid-year next year, about 8 months, which is, I think, broadly expected. But what they didn't say, what we didn't see in the minutes, is any hint that this will translate into a quicker tightening on the Fed funds rate. Right now, we're, I think, in a very interesting situation where the market is talking about an 80% plus probability of a September-November hike of 2022. And I think if the Federal Reserve wants full employment, keep in mind that we are at least 5 million jobs short of pre-pandemic levels, and with demographic growth over the last 2 years, probably around 6 million. That means we're going to have to see 250,000 jobs a month. And we certainly had a disappointment last payroll, and there's no guarantee this is going to happen. It is, for me, hard to imagine that the Federal Reserve will want to pull the trigger on the zero bound, in essence, tightened conditions, at a time where we are still nowhere near full employment, and there could be turbulence ahead. What comes to mind is slowdown in China and a bona fide energy crisis in Asia and Europe.
Okay, so I guess the gold market is still anticipating that it's still too early for Fed tightening to happen anytime soon. Now let's talk about this transitory inflation that the Fed narrative, at least, is putting out to the public. Now, the Federal Reserve has stated in the past that, especially from Chairman Jerome Powell, that inflation is transitory. Certainly, the markets don't seem to agree with that statement. I'm looking at inflation expectations, for example, the TIP ETF. That's been rising all week. In fact, it's been rising even before today's inflation print came out. Do you agree with the market that inflation is going to keep rising?
Well, we look at the break evens, and we look at inflationary expectations in the fixed income market. And I have a very complex answer for you. I do believe that to some degree this is a transitory development, a post-pandemic type of a development where we're having all sorts of logistical issues, we're having energy issues, and at the same time we had a fundamental restructuring of how we spend money. In essence, because of the pandemic, because we were all locked up in our homes, we shifted more materially into buying durable goods, which are very intensive in energy and commodities. And I think along with the supply side impact, like lack of hydropower in many provinces in China, natural gas issues, the winding down of nuclear capacity in Europe, all contributed to the sky-high prices on the energy complex. And we're seeing that translated in LNG markets. We're seeing it in our North American market in fuel as well. And we're seeing low inventories. Now, once we go beyond next year, middle of the year, many of those constraints will likely go away. However, it doesn't mean prices are going to drop all of a sudden. It just means that they're going to accelerate at a slower pace, perhaps not 5%, as we're seeing now. I'm quite confident that that is going to be lower than the inflation rate is going to be lower than it is now, 6 to 9 months from now. But I will say that fundamentally, the trend inflation versus previous cycles is going to be much higher. And we're likely going to have a Federal Reserve that will be quite happy to allow inflation to be above trend, using the argument that it's not a real problem, it's transitory. So my suspicion is that they are very much committed towards full employment. We're not quite sure who the next Fed chair is. I'm betting they're going to be quite dovish, pursuing even perhaps a more dovish policy tact. And what it means is negative real rates in terms of Fed funds rate for a prolonged period. And that is a fairly good story for gold longer term as well.
Bart, do you not think that, this is just a thought I have, feel free to disagree with me, but do you not think that the dual mandates of full employment and inflation control are self-contradicting? I mean, you stated yourself they have to be dovish in order to maintain their agenda of bringing employment back to full employment. But at the same time, if they do that, isn't that inflationary?
Well, it's tough to have two targets at the same time, but you ultimately have to pick one. And what is more important? I think right now the environment is, the Fed believes that they don't want to have any sort of scarring of the economy post-pandemic. And I suspect this is, of course, it's not like myself and Mr. Powell had a one-on-one talking about details of monetary theory, but I suspect that at this stage, they would like to see employment probably take precedence versus inflation, because they're quite confident that they know how to handle inflation with monetary policy, and they're not quite sure how to re-engage full employment. Should we see a permanent reduction in the participation rate going forward? So I think they're picking one target. They have an eye on both, and a few FOMCs ago, the Fed did explicitly say, and we had a correction in gold, if you recall, that they are not willing to sacrifice inflation targeting at the altar of full employment. But we'll see. I don't know. I suspect that they might allow inflation to be above their target for a while, particularly if they don't see employment recovering at the pace they would like. Remember, 5 to 6 million jobs still need to be created for them to be, I think, at least getting close to that before they start thinking about starting to remove some of that accommodation, not tightening.
I see. All right. So let's talk about oil for a bit. Oil is a big component of the CPI if you look at headline CPI. And of course, as we know, energy prices have been climbing all summer and throughout the fall season so far, which has largely contributed to this rise in CPI. Where do you see oil headed?
Well, we see oil I think we could see Brent at $90 this quarter as the heating season and the winter bite. What, of course, the problem is we've seen the decommissioning of nuclear plants in parts of the world. We've seen wind activity diminish. Not sure why exactly, but it has. We're also seeing in Europe some reduction of oil field activity. And in China, we've had less hydro generation. That basically meant that what we needed is more natural gas. So LNG markets got stressed, and that means there will be a level of substitution of natural gas for distillates, and that includes, of course, diesel for heating. Probably maybe gasoline to some extent as well, but mainly the heavier products. And ultimately, OPEC already said that they're already seeing 500,000 barrels per day increase in product demand. That was, I think, last week. That, to me, says if this sticks around, we're going to have a tighter market than expected. And at the same time, OPEC remains extremely disciplined in not delivering more than they promised. In fact, they were under-delivering for a while in terms of what they said. So they're only committing to 400,000 barrels of new supply. At the same time, because of various ESG concerns and risk profiles and regulations, we're not really seeing capital move into the non-OPEC space, particularly in U.S. shale. And that means that there isn't a big supply response to the higher price. So supply is pretty inelastic, and as is demand for energy, particularly when it's cold. So if natural gas is not really there to the same degree as previously. Remember, inventories in Europe are down to 72%. They're normally above 90 at this time of year. So we could have a rough winter where it is the distillates, petroleum products, which may be called upon to fill the gap. And that means a tighter energy market.
Excellent. Let's go back to gold for a minute. So taking into account your outlook for energy prices as well as inflation, as well as monetary policy, where do you see real interest rates headed? The nominal rate minus the inflation rate.
Well, I think we traditionally look at the 10-year rate, and it's around minus 1%. I forget the exact number right now, but I think certainly may drift a little lower. I don't really expect the yield curve to steepen up an awful lot right now, mainly because I think with the headwinds from energy and China, remember, the Chinese manufacturing activity index, the PMI there, is below 50. That means that we could easily see a contraction in manufacturing intake. And globally, with energy moving higher, we are going to see perhaps temporary, but a slowdown. Everyone globally now, it seems, is downgrading their GDP forecasts. And that means that yields in real terms could continue to stay quite accommodative in negative territory, maybe get even lower from this point on. We're not saying they will exactly, but there is a risk. Certainly, it's unlikely we're going to have yields start moving steeply into positive territory where it would serve as a restrictive bit of policy. I think the Federal Reserve isn't going to allow that. Ultimately, so long as financial conditions remain decent, that of course includes cross assets and the ability to fund on the corporate side, on treasuries, they might not do anything. But ultimately, if rates spike, that could be an additional problem for the economy. And let's explore another issue, fiscal spending. Fiscal spending in the U.S. may be nowhere near what I think many have thought a few months ago. Congress is having difficulty passing, not only the bipartisan bill, not only the $3.5 trillion proposed bill, reworking America, but also the bipartisan infrastructure bill. Most likely some form will pass through, but chances are fiscal policy will serve as a bit of a negative, in essence, a drag on growth. So from a monetary perspective and rates perspective, inflation, notwithstanding, probably we shouldn't expect a huge jump in rates. Still an accommodative territory, which again should be okay for gold. We're not saying gold is going to go to 3,000 or anything, but we don't believe it slides much more. In fact, over the next 6 to 9 months, we think gold does better.
Given your macro outlook, I sense that you were moderately to slightly bullish on gold, and you just confirmed my my expectation there. So great. Do you have a target? I mean, not 3,000. So between this current level and 3,000, you would say?
Well, no. So we have an exact quarterly average. In fact, we're looking at around 1825 first quarter of next year. And that variance would basically tell us that we could easily see 1875, maybe 1900 as a trading target. In fact, we put out a trade. We put out trade in our model portfolio, which we shared with the public, essentially putting a call spread where we're betting on prices moving higher.
Interesting. All right, let's talk about the PGM space now. Silver and PGMs are very important for a variety of industrial purposes. Now, interesting phenomenon we've observed over the last year is a chip shortage that has contributed to a spike in automobile prices, especially in the secondary market, because if you can't buy new cars due to the chip shortage, you're going to go to the used cars and trucks sector, which actually has contributed to the spike in CPI early in the year. So is this problem rectified?
Ultimately, yes, but we think it might not really be in full solution mode until the second half of next year. Again, this is something where we look at people who know much more about the semiconductor business than we do, and from what we're seeing, people in the know tell us that it could be in the latter part of the second half, but before this problem gets fully rectified, and that has been very, very material for PGMs, for platinum and palladium. If you recall, a few months ago, we saw palladium hit 3,016, I believe, north of 3,000, platinum over 1,300. And the big assumption was we're going to have a large recovery in automotive demand. That happened. But what we're not seeing is that demand being really satisfied as much as we thought from new production. And that meant less demand expectations for catalysts. And catalysts, of course, use platinum, palladium, rhodium, and the typical PGM metals. And that we saw since the trough, we saw well over 100% increase in PGMs, platinum and palladium, particularly strong. And then we saw a 31, 38% decline from the highs. Now it edged up a bit. So the interesting thing to us is to try to figure out what is going to happen to prices going forward. We think palladium is in a very tight supply-demand fundamental market, and it's not going to take very much for us to perhaps trend close towards 3,000. Maybe not at 3,000, but by year end of next year, we're probably going to be talking about it. Again, I suspect platinum will do well as well. That market should tighten up. Last year, we saw some million ounces or so of platinum go into ETFs, and along with catalyst demand and other industrial demand tightened that market where we saw a big jump in prices. We're going to also probably see some substitution of platinum for palladium and these catalysts, just mainly on the price differential. And we expect that market to be a little tighter than it is today. So we have a positive outlook for the industrial precious metals as the world recovers. And I think there might be a big crunch at one point where a lot of people are trying to secure the metal once the chips become available, and people and manufacturers might want to start putting new vehicles out as soon as they can. As you know, demand is quite strong, so a lot of pent-up demand for manufacturers for that.
Excellent. Bart, excellent insights today. I appreciate your outlook. Thanks for your time.
It was my pleasure. I hope to see you again soon.
Yeah, my pleasure as well. And best of luck with your work. And thank you for watching Kitco News. Stay tuned. I'm David Lin.